Hi guys, we'll continue with question 5 of the COMM 217 Fall 2011 midterm. There's a company that sells school supplies and backpacks, and they give us information pertaining to their inventory, and they tell us that the company uses a periodic inventory system. This is very important, and the FIFO inventory costing method. And the first required is calculate the cost of the ending inventory, cost of goods sold, and gross profit for the quarter ending March 31st, 2011. So we'll start with the first required. It's a good idea to make a small table. So I'll correct this. Transaction. And inventory balance. On January 1st, the company had beginning inventory from last period of 100 units at $7 each, which gives us $700. And on January 18th, they made a purchase of 700 units at $10 each, which gives us $7,000. On January 30th, there was a sale of 400 units. And remember, we're using the FIFO method. Therefore, the first inventory that's been purchased is the first inventory that's being sold. Therefore, 100 units at $7 each will be sold, and only 300 units of the 700 units that was purchased on January 18 that will be sold at $10 each. This gives us $3,700. This means that there's only 400 units left from the purchases of January 18th. If we add everything up, 400 units left at $10 each gives us $4,000. On February 23rd, there was another purchase of 200 units at $12, giving us $2,400. And on March 24th, there's a sale of 400 units. And the 400 units we're going to take is the 400 units that were left from the January 18th purchase. Therefore, these 400 units at $10 each. Leaving us reducing it to by 4,000. Therefore, this is zero left. Zero inventory left of that purchase. And if we add everything up for final time, we're left with 200 inventory at $12 each, which gives us $2,400. This is our ending inventory. In order to get our cost of goods sold amount, we'll add up all the cost of every sale. Therefore, the cost of goods sold will equal $3,700 from the January 30th sale, plus the sale of March 24th, which is $4,000, which gives us a total cost of goods sold for that period of $7,700. And finally, the question also tells us to indicate the gross profit. And gross profit is your sales minus your cost of goods sold equals your gross profit. Therefore, the sales amount will be, we'll put sales, will be 400 times 15 because we sold 400 units for $15 each. And on March 24th, we sold additional 400 units at $20 each. This gives us 14,000. And we'll have to subtract our cost of goods sold, which we've already calculated, which we said it was 7,700. This, if we subtract it, gives us our gross profit, ending with 6,300. So that will be the steps for requirement 1. Now we'll go to requirement 2. It states, prepare the journal entries to record the transaction that occurred on January 18th and January 30th. Therefore, on January 8th, first of all, we have to know that we're using a periodic inventory system. Therefore, when we purchase inventory, we'll debit purchases. And on the January 18th, there's purchases of 700 units. Therefore, the entry would be purchases, debit. Since we bought 700 units at $10 each, and we'll credit trades payable because it's all the purchases are on account for 7,000 as well. And if we go back, it tells us that January 30th, there's a sale of 400 units at $15 per unit. And in the periodic inventory system, we do not record cost of goods sold. We only record it at the end of the period. Therefore, the entry would only be trade receivable because everything is on account. We haven't received the money yet, the cash. Trade receivable debit for 6,000, and sales revenue credit for another 6,000. So that is requirement 2. And for the third requirement, if the company determines in March 31st that the net realizable value of its inventory is $11 per unit, what journal entry should you record on that date? If no entry is needed, explain why. You must know that inventory must be recorded at lower of cost or net realizable value. If the cost is greater than the net realizable value, we must have a write down. In this case, if we go back to requirement 1, we see that our ending inventory we have 200 inventory at $12 each. Therefore, this $12 is higher than the actual net realizable value of $11 they stated right here. And therefore, the entry we would make to write it down would be the following. We'll debit cost of goods sold for 200 and inventory credit by 200. And we get the 200 by subtracting 12 minus 11 times the amount of units we have left is 200, which gives us our final numbers of 200. Now we'll go to the fourth requirement. Would the company's gross profit increase or decrease if it used the weighted average cost method instead of the FIFO? You simply need to explain the direction of the change in gross profit. No calculation is required. Gross profit will decrease because the cost of inventory will be taken into all of the cost of inventory will be taken into account. The $7, the $10, the $7, the $10, and $12 will be taken into account for the weighted average cost method. However, for FIFO, we only used the $7 and $10. We did not use the $12, which was more expensive than the previous two amounts. That is why gross profit will decrease, because cost of goods sold will increase. Now for the fifth requirement, if the company used a perpetual inventory system and the weighted average cost method, what would be the cost of the 400 units sold on March 24? Show your details calculation. A journal entry is not required. I'll try to find some space. Okay. I'll erase these requirements. You guys can pause the video if you need to look at them. Okay, for the fifth requirement, we'll make the same table as we made in the first requirement. All right, on January 1st, we have beginning inventory. 100 units at $7 each, which gives us $700. And on January 18th, we have purchases of 700 units at $10 each, which gives us $7,000. And seeing that we're using the weighted average cost method, I like to add up all our purchases, our beginning inventory, before we have a sales. Therefore, we'll add up everything here, which gives us 7,700. And in the weighted average method, we're gonna combine all the costs together, and we're gonna divide the amount of units we have. Therefore, we have 800 units. 7,700 divided by 800 gives us 9.63. And on January 30th, we have a sale. We have a sale of 400 units, and since we have the weighted average cost, we'll put that number of 9.63 directly there, and that gives us a cost of 3,852. And we'll add everything up. Leaves us with 400 units at a cost of $9.63, giving us 3,852. And on February 23rd, we have a purchase of 200 units at $12 each, which gives us 2,400. And we're going to add this up as well, which gives us 6,252. And if we add up the units, we get 600 units. 6,252 divided by 600 will give us 10.42. On March 24th, we have a sale of 400 units, and the cost of these 400 units will be the weighted average cost, which we calculated, 10.42. Therefore, we reduce the cost. We have a cost of goods sold of 4,168. That leaves us with ending inventory, 200 ending inventory at a cost of $10.42 each. This will be our ending inventory. And the requirement is asking us what would be the cost of the 400 units sold on March 24th. Therefore, we go back to our table. On March 24th, we have a sale, and that the cost would be the 4,168. Therefore, cost of sale on March 24th will be $4,168. Thank you for listening. If you have any questions, please ask your teachers and they'll explain in detail. Bye.